A new company is looking to give investors the option of a private equity strategy and a low-cost ETF. Accelerate is offering 3 different funds with the goal of providing hedge fund-like service to the everyday investor. Here to explain is Julian Klymochko, CEO and Chief Investment Officer at Accelerate. Thanks so much for being with us.
Yeah, thanks for having me.
So let's talk about these products because they're a little bit unconventional. 3 products, 2 that are hedge fund-like and 1 that offers exposure to private equity. I imagine structuring these things is very complicated.
It certainly was, and we really pioneered the structure. It never had been done before. Typically, hedge funds are limited partnerships offered only to accredited investors, institutional investors, but we really capitalized on a recent regulatory change in Canada, created a new structure to bring institutional caliber long-short strategies to the ETF space.
And so one of the other things that sets you apart is you're not going to have a management fee.
Correct.
But there is a performance fee, between 15% for your basic hedge fund ETF, then 50%?
Yeah, that's 50% of the alpha above the TSX 60 total return, so any outperformance above the index.
And 20% for the other hedge fund ETF. Talk to me about why you decided to do this approach. So I guess it's more expensive than your traditional ETF, but less expensive than hedge fund exposure?
Yeah, it depends. If we underperform, then investors don't pay anything to us. And we felt like aligning investor incentives with manager incentives would really resonate amongst investors. So that was number 1. And as you said, number 2, we view our strategies as up to 80% lower than our hedge fund competitors, which are typically 2 and 20 or some variant of that. We've gotten rid of the management fee outright. So investors are really only paying for performance.
So I understand basically how your equity-based hedge fund ETFs would work because they involve public equities. But the one that tracks the private equity market, how do you do that?
Right.
Because the private equity doesn't tend to give you the liquidity that's accessible in public ETFs.
Yeah, exactly. So we created a multi-factor model that we feel could track private equity buyout index by replicating leverage buyout characteristics. So our theory is really based on the returns from leverage buyouts are really based on 3 factors. Number 1 is size. Number 2 is value, so cheap stocks based on EBITDA, free cash flow. And number 3, private equity secret sauce really is that leverage. So it's a levered value strategy utilizing liquid public securities. And we believe that over time it will track the buyout index relatively closely, but in a vehicle with intraday liquidity and fees at a fraction of private equity fees.
All right, Julian, fascinating products. Thanks so much for joining us. That's the CEO and Chief Investment Officer at Accelerate.